All right, I promised you we were going to talk about tax brackets, so let's do that. There's a huge misunderstanding out there about how tax brackets work, right? People fear being knocked into or jumping up into the next tax bracket, and that's completely inappropriate. You should not worry about that. And I'll tell you why. It's because you only pay that higher tax rate on the money in that bracket. Okay, so if you think about this, if you're married, taking the standard deduction, you've got a tax bracket, for lack of a better term, of something like 25, 26, $27,000, whatever the standard deduction is this year. That's essentially the 0% tax bracket. Okay, so that first $26,000 you earn is not taxed. Yes, it's taxed for Social Security taxes and Medicare taxes, but you don't pay income taxes on it. Okay? You probably aren't paying state income taxes on it either. So it's essentially the 0% bracket. If you're giving more to charity or you have a bunch of, tax and mortgage interest write-offs that you have even more than that, that 0% bracket might be even bigger than that. Well, after the 0% bracket comes the 10% bracket. Okay. And if you are single, that bracket's not very big. It's only $11,000. If you're married, it's twice that. Okay. But basically, for married people, it's another $22,000 you can earn on top of your standard deduction that only gets taxed at 10%. So now you've made something close to 50 grand and only paid like $2,000 in tax. Okay. So that's awfully good, right? That's a very low tax rate. What's that work out to be? That works out to be like 4% as an effective rate. Yes, your marginal tax rate was 10%, but your effective tax rate was only like 4%. The next bracket's a much larger bracket. For single people, it goes from 11,000 to 44,000. For married people, it goes from 22,000 to 89,000. That's the 12% bracket. That's hardly different from 10%. So another huge bracket. People can be earning six figures a year and have a marginal tax rate of only 12%. Pretty awesome, right? Very favorable. We have a progressive tax system as far as the income tax system goes. When you look at Social Security, that part's actually regressive. And of course, the Medicare tax is mostly a flat tax. But the income tax system itself, very progressive. So you can earn quite a bit of money and still pay very, very little in taxes. And that's why it's so surprising, right? When people go from being a resident to being an attending, residents think they're paying taxes. They actually aren't paying very much in tax at all. And so it's a huge surprise when they become attendings and all of a sudden they're now paying more than they were earning as a resident in taxes. Well, after the 12% bracket comes the 22% bracket. That's, again, a pretty decent sized bracket. It's about $100,000 for married filing jointly folks. And then the 24% bracket, again, another huge bracket. It's about, $160,000 bracket that you're still in the 24% bracket. So the bottom line is you can be earning, as a married couple filing jointly, close to $400,000 a year, not have any of it taxed at more than 24%. Then there's a pretty big jump after that. You go to the 32% bracket, the 35% bracket, and then the 37%, or the top bracket right now, starts at $578,000 for singles and $694,000 for married filing jointly. And so that's above that, you're paying maximum tax rates. Okay, so that's the way the tax brackets work. It's important to understand how they work so you can make smart decisions as you go along. For example, you don't want to turn down a raise because it's going to knock you into the next bracket, right? That would be a huge mistake, just because you don't understand how brackets work. Now, there's other things that go into your marginal tax rate. There's some phase outs on some of the deductions and things like that. There are a few cliffs in the tax code, such as those associated with IRMA, for those of you getting, ready to be paying for, Medicare. But for the most part, most phase outs are gradual. And of course, the tax brackets are relatively gradual as well. But that's how they work. And it's important to understand that. It makes a big difference. Okay. Another thing you ought to understand about taxes is there is a difference between taxes that are withheld and taxes that are actually paid. Okay. People, for example, make a comment to me all the time, bonuses are taxed higher than regular pay. Well, that's not true. Bonuses are taxed exactly like regular pay, but the withholding is often different. And the only rules about withholding are that you have to stay in the safe harbor. You have to have enough withheld or paid in quarterly estimated taxes, which is what those who are self-employed typically do, is send in a check each quarter. It's not actually every quarter. You send them in June. You send them in April and June, just 2 months later, and then in September, and then 4 months later in January. But it's, quarterly estimated taxes. You have to get into the safe harbor, which basically means you got to, either pay within $1,000 of what your tax bill is this year, or you got to pay 10% more than what your tax bill was last year to get in that safe harbor. Otherwise, you may end up paying some penalties and interest when it comes time to settle up with the IRS, because that's what tax time is. You're just settling up. If you had more withheld or paid more in estimated quarterly taxes than you owe, they send you a check. If you didn't have enough withheld and didn't pay enough in quarterly estimated taxes, you send them a check in April. Okay, but these are two different things. Don't misunderstand the difference between what is withheld and what you actually owe, because they're often very different things. Also, it's surprising. A lot of people just, don't really look at their paychecks, their pay stubs very carefully and think everything coming out of their paycheck is tax. And that is not the case. There's lots of other things that come out of your paycheck. It might be court-ordered child support. That's not tax. It might be your life or health insurance premiums if you're buying it through the employer. It might be 401k contributions, et cetera. That's not all tax, right? You can't say, well, Uncle Sam's taking 40% of my paycheck. Well, no, you're using it to buy health insurance. You're using it to buy, retirement savings, that sort of stuff. So make sure you understand what's actually coming out of your paychecks before you complain too much about your tax burden. A typical effective tax rate for most white coat investors is probably between about 18% and 30%. That's what you're probably paying if you're an attending physician. That's how much of your taxes of your income is actually going toward taxes. And that includes payroll taxes, Medicare and Social Security. That includes state income taxes. That includes federal income taxes. This idea that you're paying 50% of your money in tax is probably not correct. I make a pretty good income and I'm not paying 50% of my money in tax. It works out to be about 33% in my case. So it's, I've definitely run into docs that are paying a little bit more than me. Most of them live in places like New York and California. But for the most part, most docs are paying less than I am in tax because their income's lower.
The hosts of The White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.